Video, I will be telling you about the concept of order blocks, which is a smart money concept, and that's how the big players, your banks, and large institutions trade. This concept applies to all stocks, forex, and crypto markets. Being a retail investor, you wouldn't know this concept because the big players don't want you to make money. Now, to understand this concept better, I will give you an example. Let's say that you are an institution and you have $100 million worth of Ethereum to sell into the market. But on the buyer side, you only have $15 million worth of Ethereum for buy orders. So, what's going to happen? If you sell your $100 million worth of Ethereum in one go, the market will crash and the price will come down, and you will not get the right price of for your Ethereum. So what happens is that instead of selling in one shot, you will basically go ahead and you will have the orders in place, which is a smaller chunk orders. So that means that if, let's say, you sell off $5 million worth of Ethereum in one go, and when the price comes back to your desired level, you place another order and the order gets sold into the market. So that's where the concept of order blocks comes into play. And that's how the big players trade. So if you can understand where the order block is and you place the orders accordingly, so that means that you are playing in line with what the financial institutions and other large institutions are doing. And there is a high probability of a winning trade, and you will be profitable consistently in a longer run. So let's take an example of this trade Jasmy USDT, and I will explain to you how the order block works. Looking at the chart here. So we are using a 6-hourly chart, and you can see that over here the market had made a higher high. That is, the previous high was broken, and the market had gone up, pushing the price here. Then this resistance got tested, and then Jasmy pair went up. Now what happens is that we know that market basically either goes in a ranging environment like this, or it could be a trending market that is making either higher highs, or it could be again a trending market making lower lows, but it's a downward trending market. So whenever you have a break of structure, which is let's say that you make a higher, you break a previous high, that is, you make a higher high. So that's a break of structure, and the break of structure could be on the downside as well, which is let's say if we're talking about this example here, then your break of structure could be here. That is, you have broken a previous low and the market has gone down. That is, the break of structure has happened. Okay, so the break of structure is when the market is creating a higher high or a lower low. Now, what we need to understand is that there is a possibility, like we said in the Jasmy pair, that over here the previous high was broken and the new high was formed. Okay, that is, now we can see that there was a downward movement in the market over here. The market was trending downwards. The previous high was taken, and when in such a case, that is, a downward market reverses and a new high is formed, then we call that break of structure as a market structure break or a change of character. Okay, but that doesn't mean that the market is going straight up, or let's say the Bitcoin is right now at about $16,000 and it's going to go up $40,000 because the market structure break has happened, the change of character has happened, the market is going up. That doesn't imply. That only implies that in that particular time frame, at least for the short term, the market has reversed its direction. Okay, so now when the market goes up, the structure was broken here. So when the market comes down and it breaks the structure to the downside, because we knew that over here, if you see, we know that the market is going up in this wave. But when the market is coming down and it takes out your previous low, which is basically this one, so it went like this, and then there was a small jump here, and then the previous low was taken over here. So with this wave, you can see that this previous low was taken. Now, when this kind of break of structure happens, that is, we know that the market was going upwards and the break of structure has happened downwards to the downside, then that means that there would be an order block formed somewhere. So where does an order block basically form is the last bullish candle before the candle that led to the break of structure is where your order block forms, which is right here. So that's where your bearish order block forms. Now when the bearish order block forms, and you can see that how the price has gone down because there was a market structure break to the downside and the price just dumped completely. So we wait for the price to come back to this particular order block, and we will set our sell order at this particular level where the order block is formed. And you can see that when we had placed the order over here, the price did come back here and it got rejected from the order block. So what we basically do is we place a stop loss right above the order block. We set the take profit levels to here, and you can see that if you would have taken this trade, you would have made a straight gain of 9.56%, which is basically on 2x or 3x, it's about 18% to 27% of the gain in just a small matter of time, right? So that's the concept of order blocks, because we know that there are sell orders placed in this position, so there is a high probability that the price will go into the order block and it will get rejected and it will come back down, right? Now, it does not mean that the order block will not be mitigated or invalidated. That is, there could be a possibility that the price goes into the order block and it goes here, it wicks out here, and then it comes back down. So that is perfectly fine. That's why we set our stop loss a bit higher. That's perfectly doable. But the order block will get invalidated if, in case, the price gets at the top of the order block and it closes on the higher time frame, which is a 6 hours time frame above the order block. That is when the order block gets invalidated, and the order block then becomes a breaker. So we will talk about breakers in the next video, but in this video we'll just keep it to the order blocks. So what happens is that once the price comes into the order block, it gets rejected and you make a straight profit. Okay, now as long as we are taking our profits on the way and we are trailing our stop loss, we'll talk about risk management in the upcoming videos as well. So that's what you have to do. You just have to wait for the price to come back to the order block, and your order would be placed here, and boom, you make the profit. Okay. Now we will take another example of an order block, which is for Atom, and this is an example of a bullish order block. So you can see that the market structure, when the price of Atom had dropped, the market structure had broken somewhere here. Now when the market structure breaks, the order block will form at the bottom, which is here. This is where the order block forms, and this is the bullish order block, which basically means that the last bearish candle which was before the bullish candle which led to the market structure break is where the order block forms. Now you can see that once the market structure broke over here, the market structure broke over here, then the price came back down into the order block here. And what does this mean to you? That this order block is where the money is sitting. That means the price will come back down into the order block and the orders will get filled and the price will go up. So if you would have taken this trade, and let's say that you would have placed your stop losses right below the order block somewhere here, and you would have taken your take profit targets over here, and on a leverage of 2 to 3x, that's your 32% to 48% of gains. That is a high probability trade, setup. There is no risk involved. It's amazing risk to reward ratio as well. And there you go. Now, as we speak, there is another example of a Ethereum trade on a 4-hour time frame. So you can see that there is an order block formed here. So we have a order block formed here. If let's say you have your short targets, you place your order here, your stop loss is somewhere here, and your take profit can be here. So you get on 2 to 3x about 12 to 18% here. This trade hasn't happened yet, but this is the setup that we are going with. So now this I would like to repeat myself and reiterate myself that this is a high probability setup, but it's not a guaranteed setup. There are cases where stop losses will hit, but your stop losses hit will be way less than your profitable targets. So that means that you will be profitable on a consistent basis in a long term. So we will talk about the risk management concept in the next video. Thank you.